Good morning, ladies and gentlemen. Let us very quickly review the week that was, as always starting with the fixed income markets and the two-year note. Well, we had a bit of an anticipated rally. The figures for GDP were pretty weak, and we are long the two-year note, but we are coming to very important inflection points. 109.21 is going to be an extremely important level in two-year notes. The same picture can be seen in the 5s and 10s, which are slightly more bullish because the yield curve keeps on flattening. The 5-year note, we have a very important level at 122.10, which is not a million miles away from where we closed on Friday. We are telling you this because we are very aware of a bearish Elliott wave count for all bonds, which could be locked in if we now turn and do not make a new higher high on this move, which can be best seen in 10s and 30s. This is basically the line in the sand, 133, 15, 16. If we cannot start closing above these levels, we will most probably have a very bearish setup in all bond markets, European and US, which is counterintuitive. We have figures which show the economies are pretty weak, and we have, a period of stagflation or stagnation. Certainly no inflation on the horizon that we can see, but as we know, the market is a discounting mechanism, and as traders we are not so much trying to predict price movement, but we are trying to anticipate it and react to it. We need to have a if-then scenario. So we are at the moment long through our systems of 2s and to a lesser extent 5s, but we are very aware that these levels must give way for us to remain long, because if the market now starts failing at these levels, and in the 10-year note the level is 133, let's call it 15, and it can't break through the 76-point retracement at 133.20, then we are locking in a very bearish scenario for the next 3 to 6 months. In the 30-year note, that is also very visible, and the levels there are 175, 11 to 24. Those will be lines in the sand. If the market now gets up here and cannot push higher, then we will be bearish all bond markets. We don't know why that's going to happen, and we don't know what the trigger is going to be to turn us back down, but we just know that if that does happen, there are going to be very important and wide-ranging implications for all asset classes. So we're going to be very careful about the price action next week in the bond markets. So if you jot down these levels, 175 and a half to 3/4 in the bonds, and 133 15 to 18, call it, in the 10-year notes. Those are going to be extremely important levels, and when we get there we will be buying some puts just in case. because if the Elliott wave count comes into play, it's going to be very interesting time for all asset classes. In European markets, the levels to watch, and this is the bubble, are 133.94.95. The bubble has been much weaker than the Bund, and that is also a warning sign. The Bund is nearly back up to the top of its range, around 168.06. If it cannot start closing above it, again, that will be a huge warning sign. You can see how both the bubble and the Bund have, to the tick, respected our support levels at 165.60 in the Bund and 133.21, 22, 23 in the bubble. If those levels go, well, now we've had 1, 2, 3 tries in both bubble and Bund. If we're saying if we don't anticipate it, if those levels go, we will have probably broken the moving averages and those levels, and it'll have incredibly bearish connotations for all bond markets. You can see it again in the Bund, 1, 2, 3 tries. If we ever close below that level, we will be in serious trouble, and I'm sure that we'll be going back towards the 161 area. But that is for the long term. We are just very aware of the possibility that all these bond markets are now going to make lower highs, and this is going to be extremely important for all other asset classes. If you remember last week, we told you that bonds, stocks and gold are now more or less tied together. They will either all go up together or they will all give up gains together. Now this is the performance for the last week. Bonds were up 2% if you measure TLT. The stocks were up nothing, almost zero, but they were up. If you look at SPY, and gold was up 2%, much the same as bonds. So they are maintaining their relationship, which to us makes fundamental macro sense. The relationship was maintained by the dollar in gold, but as always, we are saying that interest rates are the market that allows all other markets to behave in the way that they allow. So the fact that bonds were up 2% allowed the dollar to come down, and that allowed gold to go up. The same we would argue for stocks. The fact that bonds went up 2% allowed stocks to tread water in their incredibly overbought condition. Let us now look at where the equities are. The equities, as we all know, have done nothing all week, but they are maintaining this incredibly overbought structure, trading right against the top of the weekly and now monthly Bollinger Bands. This allows very little price expansion to the upside, but it is fundamentally, long-term, actually a bullish structure, because the fact that the market is not correcting is fundamentally bullish for the long term. However, we do feel that being long at these levels is actually an invitation to get stopped out. We have no doubt that over the course of the next 2 or 3 weeks, the market will break down probably quite significantly and go and retest at least the breakout point around the 2130 area, and if not, just to confuse everyone, go somewhere to around 2080. So being long at 2173 or 2172 makes absolutely no fundamental sense to us. You're playing for a percent of upside for a 3, 4, 5% downside possibility. and that pattern is repeated in just about everything. Dow Jones, it had finally a marginal week lower, again very close to the top of the Bollinger Bands, doing not a lot. The market will now play around in this level, but again what we feel is the danger. The danger is for a move lower if the bonds move lower, and that is going to be what we'll be watching for. If the bonds don't move lower, but they do keep on making higher highs and don't lock in the possibility of a wave down, which actually is our preferred option, then the move up in equities is going to be tiny. It's going to be again in the order of 0.5%, 0.25%, something like that. You can see in the Nasdaq, which is our favorite market, how overbought we are. This is on the weekly time frame. We're way through all the Bollinger Bands. If we even switch that now to a monthly time frame, we are right up against the Bollinger Bands. The new monthly Bollinger Band will probably come in somewhere around the 4786 to 4800 area, and we have, although we might test it, and that is 1.5% higher, the risk reward of being long at these levels is, to us, not worth taking. The markets that are actually performing the best in terms of stocks are the DAX and the European markets in general. The DAX is in a very nice uptrend, but it does have this incredible resistance area around the 10,500 point. We are sure that we will test the 10,500 area, and here we have a gap from the beginning of the year, from the first day of the trading year, from 10,550 all the way up to 10,800. We are sure that at some stage we will fill this gap, but again the risk reward here is, on a weekly basis, is slightly better, slightly, we're not saying very much, slightly better in European markets than in the US. So we will prefer to be long of DAX and or stocks, which we feel can certainly test the 30-60 area, but they will still remain in a downtrend. We feel there is a lot more work to be done here before we are able to bust out of this downward sloping channel that we have been in for the best part of a year and a half. There will have to be a lot more work done in this area, but the risk reward of being long here and now is certainly better in the stocks and the DAX than in the SPX. On a weekly basis, again, this is very big picture going all the way back to 07. We can see that this trend line, which has held the market very well on numerous occasions, comes in just over 3,000, 3,050, while the 200-week moving average is also here around the 3,060 area. So what we're saying is there is move, but the market there is room for a move up to this 3,060 area, but that is only a 2% move in stocks, and a 60-point move in stocks happens in an hour. So it's not something that we would like to be married to. These are not long-term positions. These are just trading positions. We definitely feel that the stocks will trend towards this 3,060, 3,090 area, but we wouldn't want to be long much above there. The Nikkei actually is feeling a lot more interesting to us, simply because we feel that this very tight relationship between the yen and the Nikkei is actually coming to a somehow coming to an ending. The Nikkei was marginally down last week, very marginally down, while the yen was up big time. So we feel that the relationship is breaking down. The Nikkei could now start consolidating in this area and finally break the the downtrend it's been in for the best part of, let's call it, 2 years. We feel that a year and a half. We feel that certainly at some stage we will test this trend line around the 17,500 area. So we feel that the if one wants to be equities, long equities, US is not the place to be long. We much prefer to be long of Europe or Japan, if that is our preference to belong of equities. Moving on to the dollar index, well, it seems to have broken every short-term support. It is very oversold, but having said that, the likelihood is that we slowly now start going towards the major support line, which will be somewhere around 94, which is another 1.5% lower than these levels. We're not saying it's going to happen quickly, we're just saying that it is unlikely that the index will now be able to bust through 96 on the upside, and that we will be sellers of all rallies to 96, looking for a move back down to the 94 area. That is the most likely scenario. On the other hand, what could surprise us? Well, and that is why we are so weary of what bonds are going to be doing next week. Because if bonds now reverse hard and lock in a permanent new wave down in Elliott wave terms, that would mean that yields would be going significantly higher. If yields go significantly higher, you will see the dollar index reverse on a dime and go straight back up and basically destroy everybody the same way as it destroyed them here on Friday, Thursday and Friday, because everybody was long, and of course everybody was long at the wrong level. If now bonds lock in a move lower, and we are talking about a move which will be quite significant, because from the 140s in 10-year notes we will be going back up over 175. That is the feeling we get, and again only if the bond market turns lower at the levels that we specified earlier. If we continue higher, the DX will continue lower. But if we do get that turn in the bond market, that is not our preferred count, but we're very aware of its possibility, then watch out. The DX is going to destroy everybody again and go straight back up. And that in turn is going to destroy gold, which again is not our preferred count. Let's have a look at it on the weekly basis. But we are very aware of the possibilities. We are saying that again we are at inflection points. Remember a couple of weeks ago in our video we said we are at points of disbalance. This has to produce a big move one way or the other in all asset markets. And all big moves invariably start with the wrong side of the move. They get everybody long or everybody short, and then they bury them, and then they go. There is a huge possibility that now, if the DX reverses, gold will fall apart. But if DX keeps on going up, keeps on going down, the gold is going to keep on going upwards, certainly towards the 1400 area, and possibly quite a bit more, possibly all the way to 1528. Because that will be a new leg up in this in the instrument. So once again, looking at what the market did last week, we are saying to you that if now this reverses, if the bonds now reverse and lock in a lower high and break down through the levels that we were trading at the beginning of the week, that will have major implications through the transmission mechanism of the dollar on gold and on equities. Why on equities? Well, as we said again, these markets are now tied together. They're not tied together at the hip, but they're tied together like climbers with a rope. Let's have a look at the fundamentals of the S&P 500. The S&P 500 is trading at a 17 times valuation of forward earnings because bond yields are low. If bond yields now start going up, this market will come down in terms of multiples. That is going to be the transmission mechanism. People aren't buying equities here because they're mad. They're buying equities here because there is no other alternative, which is a better alternative. The bond market is basically giving them no choice. The Fed didn't pick QE and the permanent lowering of yields that QE brings by accident. They knew that the only way to make equities go higher is to make their valuations higher in terms of PE ratios, was by lowering the yield and therefore the risk demanded to hold all other asset classes. That is what they have done. That's what other central banks like the Bank of Japan and the the ECB keep on doing, and they keep on having the same results. The transmission mechanism again for where we are in these PE ratios is the bond market. If now the bond market comes back, we will be seeing a substantial move lower, at least to 2100, or our preferred level 2080 in the S&Ps. And that is going to be not surprising at all. The consumer discretionaries have still some move to move higher, but the important markets, which have a very big weighting in the S&Ps, are basically now stuck. If the bond market turns, nobody is going to be paying 22 times, 23 times earnings for consumer staples. Consumer staples are going to get killed. They're going to go back down to at least 10%. Energy, again, energy is a completely different animal. This, as we keep on saying, this is going to take quarters and years to resolve itself, so we would leave it alone. But the one market that could benefit would be financials, because these PE lines would actually turn sharply higher. So if you see a move up in bonds and they lock it in by making a lower low after making a lower high, we would not be surprised at all to see financial finally performing this year. Healthcare, one of our favorite sectors, we feel that it'll certainly have little pullbacks over the course of 1 or 2 weeks, but I think the trend here is clear. This retracement was very healthy, and now we are set for a longer term move higher in the ratio of at least 10% from these current levels. The industrials, on the other hand, have nowhere to go, and these are by far one of the biggest sectors in the S&P. Where are they going to go with these PE lines? Absolutely nowhere. I mean, they can get more overbought, but if the bond market now turns, watch out in industrials. Information technology, on the other hand, because these guys are so full of cash, they couldn't care less about the level of interest rates or the dollar or anything. These guys are actually pretty stable now, and the fact they have locked in this higher high to us indicates a 10 to 15% rally over the course of the next 6 months without any problem. We want to stay long of financial, of tech stocks, whatever happens to the bond market over the next few weeks. Materials, well, they could turn down substantially. And telecommunications, we feel that are pretty much stuck around this 15 area. So we're certainly not going to be buying those. Utilities, on the other hand, could get destroyed. So if you see and we'll be tweeting all this, of course, if you see a move in the bonds lower, the markets you want to short are utilities and consumer staples. The index will also go down, but of course will go far less than utilities and consumer staples. So to recap, the message for this week is watch bonds very, very carefully. This is a chart of the yield of 10 years. Watch for a test next week of this line, which is going to be around the 140, 141, 142 yield level. If we don't manage to break it and then turn, that will lock in for the first time in 18 years an Elliott wave bear signal for prices and bull signal for yield. And we will go very quickly, we feel, towards the 175 yield area. Now, from 140 to 175 is going to be a pretty massive move, which is going to actually elicit a very big response from the other asset classes. It'll elicit a big response from gold through the dollar, and it will elicit a big response in equities through the transmission mechanism of prices trading at lower PE levels, because people finally have an alternative to get yield. That is going to be very, very interesting. If, on the other hand, we keep on going lower and we lock in a lower low, that will basically mean that we are continuing in the same vein of ever higher equity prices through ever higher multiple expansion, a lower dollar, which will cause gold to rise towards the 1500 area. Not much doubt that in the next week or two that dilemma will be resolved right here and now in the by the bond market. If we can't stress this enough, all those three markets, the equities, the bonds and gold, are now tied together. As the bonds go, so do the other markets. Do not think of it in terms of risk on and or risk off. Think of it in terms of the bond market leading all the other markets in direction. Next couple of weeks critical. This is the area that you're watching. You're watching 140 yield in the 10-year notes. What happens there? Closes below there. You can buy equities almost with impunity. Closes above there, and certainly a break of any kind of trend line or or moving average, short moving average line, and this is going to become extremely bearish very quickly for equities, for bonds, and for gold through the transmission mechanism of the dollar. Watch bonds. That is the message of the week. Thank you.